Hey, what's up, guys? Hope you're doing well. James here from jamesforsythe.com. So recently, we've been going into kind of how a central bank digital currency and its implementation will affect financial stability, specifically with like private lending or private or commercial banking, right? And so basically, I want to go a little bit more in depth with that, specifically on the lending perspective, but also kind of touching a bit more on, say, actual bank deposits and such. Um, so with that being said, we'll head straight over to the screen share for the PDF, and then I'll make this a little bit bigger for you guys. Okay, so the potential for the intro of a CBDC to affect financial stability risks arises primarily from a significant substitution away from private money. We talked about this a bit last night about how basically where would it substitute, right? Would it be more the commercial bank deposits or demand deposits like your checking account, or would it be more like cash? We should kind of like, there have been studies, I believe they used survey data from Canada, I think, off the top of my head, basically going between saying like the adoption of a CBDC would be anywhere between 4 to 55%, depending on how much that's kind of weighted, with the lower end being substitution to cash or from cash, I should say, and the 55%, the higher end of that range, being more demand deposits, right? And so while this substitution, specifically with cash to CBDC, um, is generally regarded of having no implication on financial stability because it's more of the system itself, and so they're kind of thinking that basically if a central bank digital currency were to replace cash, it wouldn't really have much an effect on the system itself because you're essentially just changing a different form of the same counterparty, right? Because they'd both be liabilities of the Federal Reserve, right? Um, whereas the demand deposits are liability of the commercial bank, whatever you're banking with, right? Or I guess whoever you're banking with. And so kind of a change in liability and also the system itself of where it's kind of functioning, right? And so absent having limits on individual holdings, a CBDC, like other forms of digital money, could lead to higher volatility in deposits or significant long-term reduction in customer deposits, right? And so basically, this would cause banks to go other places, right? If they didn't have their deposits, they'd have to find other forms of assets, or I guess they're technically liabilities on their balance sheets. But in terms of maintaining reserves and functions to remain profitable, right? The main point of this on how it could affect uh, financial stability is through the stability of the bank's profits, right? So how can banks continue to profit? And if they no longer have deposits on which to function with, whether it be through lending or other ways, um, basically they'd have to find something else, right? And so they go on to say consumer deposit funding is at the heart of the commercial banking business of maturity transformation and intermediation services. So away from issues of the zero lower bound, any material loss in customer deposit funding would require banks to consider combinations of actions to try and maintain regulatory ratios and risk adjusted profitability, right? And so kind of the main ratio they're talking about is the LCR, which I think is the leverage coverage ratio. Um, and so they go on much more in depth with this, especially there's a part in the appendix where they actually kind of model this with very simple, like algebraic math, kind of showing inflows and outflows with such a thing, which are with deposits specifically, and how that would change depending on how much substitution is made. And we'll get into that in a later video, probably later in the week, right? So examples of what banks would possibly do in kind of retaliation of a CBDC, right, would be switching to alternative market-based funding sources. But those could be more expensive and in some cases less stable. Their words. Also, they could reduce assets or deleverage, increase the risk taking that they take to mitigate. They say near-term margin compression. I don't know why I can't talk this morning. Sorry. um, Also, the biggest thing is increasing lending rates, which they kind of contribute to a whole section later, which will probably be tomorrow's video, along with other things, right? And so, while there are studies suggesting both positive and negative overall effects of a CBDC on aggregate lending and economic activities, a common theme is that maintaining bank profitability levels could be challenging, and that the magnitude of the implications will depend on the exact design of the CBDC. Again, it's all dependent on stuff. And this is where this next highlight, talking about the stylized model on aggregate of an aggregate banking system. Basically, this is the model I alluded to earlier. They're also assuming positive rates going from there. We'll go more in depth of that into a future video, right? And so specifically, we can consider one case where the banking system seeks to offset all CBDC capture of customer deposits via long-term wholesale funding, which is they say is a costly alternative to customer deposits. So in this case, following deposit outflows, banks seek to maintain their lending volumes and leave the regulatory liquidity ratios unchanged. So there's that, right? And basically what they'll have to do, and I'm just going to go straight down to it. It gets down to here where you have before and then after the CBDC, and this is kind of modeling their balance sheet. So they're basically saying that in terms of the assets they must hold, it doesn't really change very much because the difference between how deposits and wholesale funding are weighted on their, and I misspoke earlier, it's the liquidity coverage ratio, which is the LCR. And as you can see with wholesale funding, basically replacing deposits, they have no increase really of HQLA, which they call high quality liquid assets, right? And so they don't have to increase that significantly because those assets are basically weighted via this ratio, this kind of metric, to the same way as deposits. And so it's basically like how much assets does a bank have to hold to basically back, so to speak, certain amount of liabilities or a certain type of liabilities. So it's kind of like the more, say, for example, like risk or something that a certain liability takes, whether they're buying or whether it's just a customer deposit or wholesale funding in this case, where they have the same one or relatively the same one. Whereas if they went and started to buy like equities and like very high interest, like corporate debt, things like that, like junk bonds or whatever. They'd have to have much higher, or be, they'd have to have a much higher. Let me articulate this better. So they have to basically back it by more reserves in a way, and by reserves, I don't necessarily mean like bank reserves. I'm basically talking about these assets, right? So basically, they have to have more asset per unit of liability per se, because of the nature of that liability, right? So there's that, and some actual like insights, and this is where they just start to cite lots of papers. Probably get into later, but a sizable body of literature, and they give three citations, stipulates that a CBDC would structurally decrease deposit funding available to commercial banks as a CBDC being on par with deposits with regard to liquidity and convenience would also offer advantages as a safe haven asset. So we talked a little bit about this, I believe, last night, kind of comparing like the difference between how a regular person views cash versus their demand deposits. And so saying like maybe the reason why if a CBDC were to be implemented, people would basically choose or substitute that more with their demand deposit is because to most people they don't really see the difference. It'd be kind of the same thing. It's a digital payment. They just swipe a card, whatever it may be. Whether you tap your phone or use Cash App or whatever you can think of, they don't. It's digital. They don't really make that distinction between the two. Whereas with cash, it's a very obvious distinction because one's digital and one's physical. And so, kind of the advantages, I guess you could say, of cash is much different than demand deposits, right? And so, it's kind of this is where you get with regard to mostly the convenience of it. Um, liquidity, basically the same thing. And so that's why, because demand deposits and the CBDC would be so similar in those respects, it would basically be much easier for it to substitute demand deposits, right? So that being said, two other papers argue that in an imperfectly competitive deposit market, the existence of CBDC as an outside option forces banks to match the CBDC rate to retain their deposits, which would eventually have a crowd-in effect of encouraging saving, right? And so basically, they talked about this, or we talked about this last night as well, I think. Basically, it was like, I forget what year it was, but there was a study to where it's like they saw a 1% increase in the deposits, the interest rate you can get on your deposits, only saw like a very minimal increase in the actual amount of deposits, right? And so they called this, for some reason, I can't remember the exact term, but it was like demand inertia or something. Basically, like even though there was relative to where it is now, a significant increase in that interest rate, um, there wasn't much of an increase in demand, so they had to overcome a certain amount of inertia that would require an even larger increase relative a larger increase of that deposit interest rate relative to what's already there, right? And so that's what they mean by imperfectly competitive deposit market, because even with that increase, there wasn't much of a shifting of deposits around for people wanting to get the higher yield, right? Because that's not really, or because of that, I'd assume that's not really their purpose for holding their deposits there. It's kind of supposed to be like a safe thing to where they don't really touch it. They don't think about it. It's not, they're not searching for yield in that respect, right? And so basically their argument here is that a CBDC would basically make the commercial bank deposits or the commercial banks increase that deposit rate to be on par with the CBDC. And basically, by increasing that rate, I'm assuming by a crowd-in effect, I mean they're basically creating a way for people to incentivize savings, to where people they don't really have an option to get out of that, right? And so basically, if you're going to have any digital deposits in a way, it'll be in one of these assets or some equivalent to where the interest rates are going up, which would kind of like that saying, a rising tide raises all boats. You basically have with all the interest rates going up, everyone's kind of being included in that, and which is overall incentivizing saving, right? Um, so another way they say this is also having the CBDC itself bear interest. And so they say this will increase financial inclusion in the system, especially with a non-perfect competitive banking sector, as I say, which they think will also diminish the demand for cash, right? And so this is one thing, just like, will they even outright ban cash? They they explicitly state in the paper that they plan on continuing to issue cash, but it seems like with the caveat of as long as there's demand for it. And so if this kind of just so happens to get rid of that demand, then they'll just stop printing it and then there's nowhere to escape, right? In a way, right? And so if banks respond to a CBDC by increasing reliance on market funding, then depending on the type of market funding, which would be like wholesale deposits, long-term debt, longer-term money market instruments, things like that. Banks' maturity transformation and their liquidity risk may face upward pressure because of more reliance on less stable funding sources, or some downward pressure if market discipline increases. They say that the volatility of market-based funding may increase the pro-cyclicality of bank lending. All right, so basically, would the issuance of a CBDC basically reinforce a cycle and say like booms and busts specifically with respect to bank lending? Will there be in periods of where there's a lot of bank lending, will there be even more? Or when there's not bank lending, will there be even less? And so basically, are you accentuating those cycles, right? Um, which I might read that paper just to kind of get more in depth on that specifically. So competition from CBDCs may also prompt banks to increase deposit rates. Kind of alluded to this earlier. And so in Keister and Sanchez, higher deposit rates led to lower lending as some projects that are profitable at a lower cost of funding fail to secure cost-efficient bank financing, right? So I'd assume the higher the deposit rates basically means the bank is having to pay more to their depositors, and so they don't have as much I guess, principal to lend out, right? And so basically they'd have to essentially get rid of the, I guess you could say, not non-profitable, but how to word it. Basically I can't believe I can't remember the specific term for it, but like giving out loans for things that don't aren't very productive. So like unproductive lending, right? So basically like getting rid of like zombie companies in a way, right? Things like that. And so another set of papers, sorry, argues the intro of a CBDC by a central bank could cause a reduction in commercial bank deposits, which would consequently translate into more expensive credit lines. Kind of along the same thing, to where the loans would have to have higher interest rates because the banks would need more interest in order to pay the interest on their depositors, right? And so kind of going that route. And that would basically translate to higher like mortgage rates um, and similar kind of lending that you could get from a commercial bank. So also, you could argue that even if the CBDC is not used in equilibrium, its intro would provide a lower bound on deposit rates. So when they say would limit monopoly profits. So basically, as with always, and I've tried to make it a rather large point in all these papers is there's a cost benefit analysis that has to be done with everything, whether it be some effect of a CBDC or a core feature or things like that. You have to really look at it on aggregate total and kind of fit a specific profile with an environment, and that's why um, it's important to realize that a central bank digital currency would be different for every jurisdiction because that different jurisdiction has a different environment. And so from there, it needs a different profile that would actually be beneficial. And so you can't just kind of have a one size fits all and push it on everybody because that's not really how this works, right? And so, especially with like differences in cash and things like that. Um, and also just, I guess, culture in general, because some places still use a lot of cash, but some don't. Um, just kind of really depends on the culture and how that changes, and even that, I'd assume, like, demographics kinda has a way in it, because if you look at different kind of demographic groups, they behave differently, especially financially, and so, like, I don't know very many young people who have a lot of cash, whereas, like, when you get into a much older demographic, they typically do, or they use it more frequently. Like pretty much everyone around my age group, if they want to transact or do anything between amongst themselves, it's like using some app or something like Venmo or Cash App or whatever. But whenever I deal with or work with some of my coworkers, which are a lot older than me typically, um, they'd probably kill me if they heard me say that, but it's always cash. And a lot of the times it would be like I'll have to um, Cash App them, and then they'll give me cash in return or something along those lines, right? Because they have trouble. Some of them don't really understand how to work bank accounts and stuff, or not necessarily bank accounts, but they're not very technical in that respect. And so it's like I'll have to take care of that end to make it easy on them, and they'll just pay me in cash instead. And basically, it's like the amount of money moving around is the same. It's just different forms, right? But anyways, kind of a little bit of a side note, but yeah. So I guess a main takeaway would be paying attention to how a CBDC would directly affect bank funding and lending from the terms of or with respect to financial stability, right? And so it'd be really interesting to see like how a CBDC would affect the take up. I'm sorry, how the take up of a CBDC would affect banking in general. Not only just rates, but even the rates you could receive in your bank account, things like that. Um, so it would be interesting to see some more data that they, I guess, produce on in this respect, and that's something I'll start to like actively look for. And if I find anything, I'll make sure to share it. So that said, stop the screen share. Anyways, I'm gonna leave that there. So if you guys have any other further questions about CBDCs or whatever, I'm actively searching for this stuff and kind of sharing it as I find it. Um, there's also entire playlists that I'll link to like the end cards and stuff, and so it'll be here or there, however it is. I don't know how it reflects, but via the camera for the end cards. But anyways, it'll be there. Basically, I have a playlist for all the CBDC stuff and just kind of looking at it from every respect. So if you guys have any further questions, first check out there. So, anyways, I'm going to leave it there. So make sure you go watch one of those and hope you guys.